Let's turn to private credit now and its increasingly important role in helping to address Australia's housing supply crisis. Kathy Houston is a real estate credit managing director from MA Financial. She joins us now. Kathy, good to see you again.
Good to see you too.
Now, inevitably, I'm going to ask about Donald Trump. That's a starting point for every interview, it would seem, post-election, given he is returning to the White House and looking to upend the global order at this point, particularly in financial markets as well. So is it too early to say what potential impact his presidency and his policies could have on private credit?
I think, well, from private credit's perspective, the great thing about private credit, about any credit product, is that you have a buffer. And what that means is that credit has some protection from the equity part of the capital stack. So what Trump means, really, who knows? But what it does mean is that there's a lot of uncertainty in the market because we're actually not sure what's going to play out, what he's going to do. And that can lead to some volatility. And volatility can be good or can be bad. But from a credit perspective, because credit has that buffer in terms of that capital stack, it means that there is some protection there from that volatility.
All right, so let's turn to what we're seeing in private credit markets then, and particularly, I guess, non-bank real estate credit, which appears to be growing more and more. Why is that?
I think that, well, from an industry perspective, the banks have, in Australia particularly, the banks have a very strong position, and they've held the majority of the capital for real estate in Australia for a very long time. And if you look on a global stage, you can see that the non-banks in the US or the UK have had a much higher proportion of the capital for real estate than what they do in Australia. And what we're seeing is, with the additional regulation and capital requirements that banks have, that it's really opening up that market for the non-banks in Australia. And then Australia is a very attractive market from an international perspective for international capital, because we have a very stable base. We've got the rule of law in terms of our legal documents, political, very stable. So, and given the relative volatility, if you like, in some of the other Asian investment markets, it means that it's a great place for people to invest and to invest in credit, and then absolutely in real estate. We have a really strong, as you know, undersupply in terms of housing, and so that's a strong thematic that gives confidence to people when they're investing in credit over residential, that there is that push, if you like, that will keep those residential prices unlikely to fall down on an average basis.
So what are we seeing? You mentioned that gross undersupply of housing we have at the moment. So developers are trying to keep up, essentially, and well, it's a bit of they're losing the race, it would seem, particularly with that government target of building 1.2 million homes by the end of the decade. Nonetheless, are we seeing then developers turn to the non-bank lenders?
Absolutely.
And why are they seeing the benefits of that?
Well, I think it's multiple reasons. So it used to be that when people thought about non-banks, it was really around a lender of last resort, if you like. So if you couldn't get your money from a bank, then you'd go to a non-bank. But really, we're becoming a core part of the system now. So there's more people out there. We've got a track record of actually being able to supply the capital that developers need. We're able to think a bit more outside of the box and not necessarily be constrained by a lot of policy that banks have. So particularly in regard to pre-sales, at the moment where there is not this certainty around having capital appreciation, it means that there's less desire for people necessarily to buy off the plan, which makes it hard for developments to get off the ground. In the bank space, they still generally have quite high pre-sale requirements, whereas in the non-banks, they're able to look through to the fundamentals of the risk and really assess the projects and not necessarily require the same level of pre-sales. So that gives the developers the ability to start these projects, get them off the ground, and then slowly accumulate those pre-sales through the construction period.
All right, now you make a distinction between sophisticated and perhaps non-sophisticated non-bank lenders. What's the classification there?
Well, if you like, this is one big risk that I see in the market is that their non-bank space is very varied, and so there might be some people who have been brokering for a while and doing originating some transactions, and all of a sudden they decide they're going to become a non-bank. But they may not have any experience in terms of actually managing the loans and working through issues and so forth. And then you have bigger, more robust platforms like MA, where we're a listed company. We have lots of governance. We have people with experience throughout the cycle. So there's a big spectrum, if you like, of non-banks in the market. Obviously, we need people, both investors and borrowers, to be really assessing who they're dealing with and making sure that they are understanding the parties that they're dealing with, so that they don't get stuck.
So, I mean, for any lender, it comes down to risk.
Absolutely.
Doesn't it, of the borrower. So are non-banks able to assess that risk perhaps quicker than traditional banks?
Yes and no. So traditional banks may have had a relationship with the borrower over a period of time. The non-banks won't necessarily be a deposit taker or have that long-term relationship. So they still have to do their due diligence. Non-banks, we see non-banks all the time being quite quick in their approach and allocating the resources to really do their due diligence. It doesn't necessarily mean they're not doing their due diligence. They're just going about it in a quick and efficient way, if you like. So I wouldn't necessarily say it's better or worse, but we do see the stats do show, and the borrowers do tell us that the process is quicker when dealing with non-banks.
All right, is most of this what we're seeing, particularly that growth for the non-bank lenders in loans backed by real estate then?
Oh, look, I think it is in all parts of the credit market. So we are seeing non-banks playing part in the corporate, in the asset-backed, and also in the real estate. Real estate credit is where I'm focused mainly, but we are seeing it throughout the whole credit market. With the real estate credit, obviously. It's a big area that international players and international capital are looking at, given our residential thematic and wanting to get into that and wanting to provide credit to assist in the push and the supply of that housing into the market.
So, Kathy, if Australia is to adequately address that gross undersupply of housing, what role does private credit have then in facilitating that?
So private credit is really around just trying to find ways of structuring the transactions so that we can get this supply into the market. So it's really around working with the developers, trying to find ways for the feasibilities to work so that we can get some of these developments off the ground. So not being stuck with having particular policies which may obstruct that supply getting into the market. We really want to see that if there is a way that we can make it work, then we do that. But obviously there are still lots of transactions or opportunities out there that we will say no to because they just don't stack up.
And given that growth we're seeing in that sector, then what are the investment opportunities?
Well, the investment opportunities are wide and varied, and so from my perspective, we are very much focused on senior lending because we want to be able to make sure that we can control from a credit perspective, but actually work with the developer, be in the box seat to actually work through any issues as they arise. So with a construction project, things don't necessarily always go exactly to plan, and it's about being able to work through those issues with the developers so that we can get to the end and everybody gets happy.